Hello everyone, this is Dr.R.Thulasiram, Associate Professor, Department of Social Sciences, School of Agricultural Sciences, Bharat Institute of Higher Education and Research, Chennai. So today the topic of discussion is cost concepts and its types. So this is one of the very basic topics that is being covered inside the course Fundamentals of Agricultural Economics. So this is a basic agricultural economics course, and this course will serve as a base for all the other agricultural economics courses that has been covered under BSc Honors Agriculture degree. And they have different courses like production economics, agricultural finance, marketing, agricultural marketing, trade prices. For all these basic courses, they need to come across the word called cost and various types of cost and cost concepts. So in the basic course like this, students have to understand what it is all about. What is a cost? What are the different types of cost? Why it is so important to consider learning the concept of cost. Let us move on to the topic. First of all, before going deep into the topic, we should understand what is cost. And we need to compare cost with price and value also, because there is normally a misconception about these words, three words. First of all, price is what you pay for any good or services that you want to get. That is what you pay. That is value of that good. And cost is the amount of inputs incurred in producing a product. If you want to produce any commodity in your industry or in a factory or even in a piece of land, you want to cultivate and produce a food grain, you have to incur some input. And for each and every input, you have to spend some money. So that expenditure is called as cost. And value is what goods or service pay you when you possess a good or service. When you are a teacher, you provide teaching service. Okay, the money that you get for your service, that is called as value. And if you possess a good, when it has some value, then it's also coming under value. And the cost is nothing but expenditure. No, you need to invest in a business. You need to buy a capital. Say, for example, tractor, land, building, inputs, other raw materials, etc. in any business to produce a commodity. And that is coming under the category called expenditure. Right. So cost, normally we have two types. Basically, right? So in a larger part, you have basically two types of cost, which is very important. One is fixed cost and another one is variable cost. Fixed cost, it is denoted by capital FC, and as the name indicates, it is fixed irrespective of the level of output. Whatever may be the quantity of production that you want to have, this cost incurred in these kind of fixed inputs, that is same for all the quantity of output that you produce. If you produce 100 kg of a product, this remains same. The cost incurred in fixed input are same. When you want to produce more, 300 kg, 500 kg, 1 ton, whatever it is, the quantity of production output, this fixed cost remains same. Right? Examples are land, building, machines. So in any business, when you incur some money for land, for each and every production cycle, you are not going to incur money again for the same piece of land. Land, once it is purchased for cultivation, it is purchased forever, and that can be used for multiple production cycles. So the cost that you incur for such input is fixed over a period of time, irrespective of the level of production. So that is why it is called as fixed cost. And the same is for building, machineries, etc. Right? So if you don't produce any output also, this fixed cost exists. Say, for example, if you have land, building, and machineries there, and if it is not in a running, if it is not running, that means you are not putting any raw materials or inputs to it. That means you are not going to produce anything. That time also, you have incurred some amount over those inputs, and that is called as fixed input. Even if you use it or not, if you produce it or not, still you should have incurred some amount of these inputs. Whereas variable cost, the second type of cost, as the name itself indicates, it varies with the different level of production. Say, for example, if you want to produce 1,000 packets of potato chips, you have to give 30 kg of potato. If you want to produce 2,000 packets, again, you have to increase your raw material input. So this kind of inputs changes with different levels of production. When the level of production increases or decreases, the money invested, money incurred for these variable inputs also changes. Either it may increase or decrease. Example, all the raw materials inputs that you use as a factor of production. That is expenses on fertilizers, seed purchase, chemical purchase, fuel consumption, electricity consumption in your cultivation of crops, etc. That will be coming under variable cost. So that is, it changes with the level of production. When the level of production increases, this cost incurred in variable cost also will increase. Right. As I told you, left hand side you have fixed cost, right? When you incur some money over this fixed cost, no, if you are not producing anything, it is idle. Even when it is idle also, you have incurred some amount on fixed cost. But when you call your business in a running condition, then you have to incur money for variable inputs. If you don't purchase raw materials, of course, you are not producing anything. These fixed assets will remain as such idle. So when you invest some money over variable assets, then only you can call your business is in running condition, right? So that is why I just included idle and run. And variable inputs are the inputs which directly influences the production. Okay, when you don't have a fixed asset also, you can still produce something. Say, for example, you take a tomato squash, tomato jelly, jam, etc. Even when you don't have a exact machinery that is used to produce this tomato squash jelly, you can still mash it by using manual method, right? So just by keeping raw materials, you can get the finished product. So that is why variable cost, it is useful to show that your business is in running condition. And that is why it is otherwise called as running cost. And it is directly influencing the production. When you don't have machine, you can still produce. But when you don't have raw materials, you cannot produce anything. So it directly influences the production. And that is why it is called as direct cost. And it is the main cost in any production. That is why it is called as prime cost. And when you call your business is in a circulating position, that is, you are continuously doing the business, means you have to incur some money for these variable inputs, right? And those costs are called as variable cost. And those money that you incur for fixed assets or fixed inputs like land, machine, buildings, etc. are called as fixed cost. And it is not directly related to the production. And that is why fixed cost are otherwise called as indirect cost. Right. As I told you, when you add both this fixed cost and variable cost, you will get the total cost. In any business, it is not only the fixed cost that you want to incur, it is not only the variable cost that you incur in terms of spending money for variable inputs. It is the combination of both. You have to incur both fixed costs, some money for a fixed cost and some money for variable cost. When you add both these costs, what you get is called as total cost. So it is the cost, it is the sum of total variable cost and total fixed cost, which we have seen in the previous slide. And total variable cost, as I told you, it is called as out-of-pocket cost. Every time you have to spend some money out of your pocket. And it is the sum of expenditure on variable inputs for any level of output. In short run, you keep on changing this level. When you want to produce more, you will incur less. You will incur more money for variable cost. When you want to produce less, you will incur less for variable cost. So in short run, it keeps on changing. That is why it is called as, it varies, this variable cost. So total fixed cost is sum of expenditures which you incur irrespective of the output level. Even when you don't produce also, you will spend some money. That money is called as fixed cost. Next one is the marginal cost. It is marginal in economic terms. It is called as additional, right? So when you want to produce one additional unit of output than before if you have produced 10 kg, now you want to produce one more additional unit. How much money you are incurring now in extra additional money, how much you are incurring? That is called as marginal cost, otherwise called as additional cost. It is the money that you incur to produce one additional unit of output. Next one is average variable cost. That is average variable cost. That is taking average for the total variable cost. The total variable cost is the cost incurred to produce the total amount of output. Okay. The total amount may be 100 kg. But average variable cost is the variable cost incurred to produce 1 unit of output. By taking average, that is TVC divided by total units of output, capital Q, you will get average variable cost. Next one is average fixed cost. It is also by working out by dividing total fixed cost by the total amount of output, that is TFC divided by capital Q. And average total cost is you take average total cost by unit cost of production, cost of producing 1 unit of output. How much money is required, both in terms of fixed and variable cost. Right. Just for a summary, total cost is equal to total fixed cost plus total variable cost. Average total cost is total cost plus number of outputs, that is AFC plus AVC. Both average you can add, you will get average total cost, average fixed cost plus average variable cost. And TFC is sum of all the fixed cost, and AFC is TFC divided by number of output units. And TVC is total variable cost that you incur. That is, you have some price for your inputs, and when you multiply the price with total quantity of input that you put in your business, that will give you total variable cost. Say for example, if you want to incur some 20 kg of fertilizer, so 1 kg of fertilizer may be 10 rupees, so 20 into 10 will give you total variable cost. Likewise, you have lots of variable cost: seeds, sowing, labor, wages, electricity bill, irrigation charges, etc. Rent, if you take a tractor for rent also, you have to pay some money. So all these things are included inside variable cost. An average variable cost, when you divide the number of units, with total variable cost, you will get this thing, right? And marginal cost, as I told you, it is the change in total cost when you want to produce 1 additional unit of output. In your business, if you want to increase the output by 1 additional unit, how much additional cost that you want to spend? That is the marginal cost, otherwise called as additional cost, right? So this curve will explain you about total fixed and variable cost, right? So on the right hand side, you can see the x-axis, it is given the quantity of output. The y-axis, the price is given. So fixed cost, as you can see, the 20 lakhs, you can take it as 20 lakhs. Y-axis unit is 20 lakhs. Okay, y-axis is given in lakhs. So 20 lakhs at the first starting of a business, that is, you incur money for land, building, machineries. It is 20 lakhs you have already spent before starting your business. That is, before investing for raw materials, before producing anything, you have already spent 20 lakhs. So this 20 lakhs remains the same for 1000 kg of output, for 2000 kg of output, for 3000 kg of output, 4000, 5000. This fixed cost remains same because the same land, building, machineries will be used as such, right? It is what it is mentioned in the left hand side picture also. You can see that yes is 20 lakhs. It remains same in the first year, second year, third year, up to last year, X, 7th year or 8th year, whatever it is. And variable cost, it starts from 0, right? Variable cost, it starts from 0. You can see in the left hand side curve, it starts from 0. First you incur 1 rupee, 2 rupee, 3 rupee, likewise it keeps on increasing. And total cost, when you add this variable cost and also fixed cost, you will get total cost called TC, and that is what mentioned here. TC is equal to TFC plus TVC, right? So this again, in this curve, in this curve you can see I have added marginal cost, average variable cost, and average fixed cost. So each and every cost will behave differently. Say for example, if you take marginal cost, okay, so when you want to produce additional unit, you have to keep on adding more and more cost to get additional unit, because the land will get less fertile when you keep on using the same land for cultivation. And average cost also, when you produce little, say for example, you can take this point here. Here the output is very little output you are getting. When the output is very little, the average cost is high. That means you have incurred more money, you are taking only limited output. When the output keeps on increasing, you can see, as you can see, when the output keeps on increasing here, the curve starts to decline. That is, average cost will come down when you keep on producing additional. It is more like your 10th standard, 12th standard marks. No, if your mark is more 450, if you divide it by 5, the average will be 90, right? So when you keep on adding more and more marks, the average will come when it keeps on coming down. The same way, when you keep on increasing your output more and more, the average cost incurred to get 1 unit of output, it will decline. After some time, again the land becomes less fertile, right? You need to incur lots of extra money there. So the output will come down. So the average will increase. It is same for all the other cost curves also, right? Right. So as I told you, marginal cost is the addition to the total cost caused by the small increment in the output level, right? So marginal cost also falls at first due to more efficient use of variable factors as output increases. In any business, first it will be efficient, more efficient, where the average cost will be very less. It will keep on going down. After some time, it becomes less efficient, so you have to incur more and more money for producing 1 unit of output. So marginal cost is otherwise called as additional cost, as it is given here in this formula. Change in cost due to the change in 1 additional unit of output. When you want to change the output unit, you have to change the money that you incur. That is additional cost. The next one is opportunity cost. Opportunity cost is a very interesting concept. Okay, so when you have a limited resource, say for example 20,000 or 25,000 in your hand, and you want to do a business, you may have lots of alternatives. Now, choice A, choice B, this business, that business. So now you prefer business A instead of business B. You will get some return. That is okay. But to select the business A, to select the choice A, you have sacrificed choice B. Now, if you have selected the choice B, you would have got some return that you have lost, isn't it? If you would have selected the choice B, you would have got some return out of that business that is lost. That is what you lost now. So that lost benefit is called as opportunity cost, because that is what you lost to get other alternative. To get choice A, you are losing the benefit that you can get from choice B. So that is why it is defined as the value of benefit foregone, which could be obtained from the same resource of 20,000 in its next best alternative use. The next best alternative use for A is B. The resources can be used for A, but the next best alternative is the same resources can be used for B. So the benefit that you lost for not using the same resource for choice B, it is lost forever. That lost is called as opportunity cost. Next best alternative, that is foregone. The next cost is sunk cost, right? It is more like a one-time investment, right? You will invest only once for a particular capital, but you will not use it very often. You will use it only once. You can take example like, no, you have paddy thresher. Paddy thresher in the sense, it is used to separate paddy husk and paddy grains. So whenever it is harvesting, that time only you will make use of this capital. You take cane crusher. Sugar cane crop is there. So for sugar cane exclusively, there is a equipment called cane crusher. It crushes sugar cane. Since sugar cane is an annual crop, so not very often you will make use of this equipment, but you will use it only whenever there is a harvest process. So one-time investment, but you will use, not very often, you will use these equipments very rarely. So that cost is sunk for that particular capital. It is gone, right? So that is why it is called as sunk cost. Next one is explicit cost and implicit cost. Explicit is in the sense, if you want to buy any additional input in your business, if you want to purchase a new asset, if you want to hire 2 or 3 or more laborers in extra for your business, if you want to purchase new raw materials, you will spend money out of your pocket outside your business unit to buy something. The transaction cost is called as explicit cost, X outside. Implicit, of course, you will lose some money, but you will not make a note of it. It is not tangible. It is not countable. Say, for example, if you hire a worker, the single day wage for a worker is 350. If you hire 3 workers, 350 into 3, that is 1,050 that you can make a note of. That is countable. The cost is countable. But whereas in implicit cost, no, if you lose any labor, if you give a day off for your workers, right? So that may lead to a drop in sales and income, but that you cannot make a note of, that you cannot count it because of one day absence, how much we lost, how much grains that we lost, how much output that we lose, that and all you cannot calculate. And that will not be entered in balance sheet. Balance sheet is a sheet where you have assets and liabilities. And what are the expenditures that you make, that also you will make a note of. But since it is not a countable one, you cannot make a note of this implicit cost inside a balance sheet. So such kind of cost that cannot be countable and that cannot be included inside a balance sheet is called as implicit cost. Next one is recurring cost and non-recurring cost. Recurring cost is a continuous cost. Daily you will incur some money. Weekly you will incur some money. Every hour basis you may incur some money. Month-wise you can incur, etc. Costs are called as recurring cost. Direct cost. It adds directly to the production. It's a direct cost. Non-recurring, you will spend this money only once in the business. Okay, for development activities, for land development, you can develop the land one time and you can use the developed land for some multiple production cycles. Investment, you can invest in new machine, you can import a new machine from other country. That may be harvester, combined harvester, right? So all these things that you can incur only once in your lifetime, at least for 10 years of time. So that costs are paid only once, and such costs are called as non-recurring cost. It is not continuous, it is not regular. And incremental cost is other name, just another name. It is very closely related to marginal cost. It is the cost associated with increasing production by one. If you want to increase your production by 1 unit, you will incur some extra cost. That extra cost is called as incremental cost. Right. So we have seen different types of cost concepts technically, and also generally also we have seen some cost types like recurring, non-recurring, etc. But why it is so important in economics? Why the cost concept is so important? No, we can read about lots of topics, but what is the application of such topics? Why cost? Why expenditure is so important in any business, or why it is important in economics? That we will see now. Okay, in any business, for a farm worker, or for a farm businessman or farmer or a businessman, agri-business entrepreneur, in any business, the ultimate motto for the person who runs the business is only two. One is cost minimization and another one is profit maximization. Okay, their ultimate aim is to minimize or reduce the cost that they incur and to maximize the profit or return or yield or output in their business. That is their motto. Either you can increase the revenue or by increasing the price or increasing yield, or else you can decrease the cost. Both are same. Okay, whatever you are capable of, you can do it in the business. Okay, so in that sense, when you keep on reducing the cost, you will get more and more benefit, right? And cost can be used to make some decisions in your business. Okay, some important decisions. Such decisions are two types. One is break-even point and another one is shutdown point. So break-even point is nothing but, I'll make it very clear, in any business, at some point of time, the fixed cost and variable cost that you have incurred totally, that will be equal to the revenue that you received from your business in total, right? It may take 1 year or 2 years or 3 years, because when you start a business, you would have incurred some 30 lakhs for fixed assets, that is land, building, machineries. And after that, for every production cycle, you would have incurred some variable cost, 50,000, 50,000 for every production cycle. So you add both this cost, it may be 40 lakhs. So at any point of your business, you will take this total cost that you have incurred so far in your business. So all the 40 lakhs that you will take out of your business through different revenue in different production cycles. So when this total cost, the money that you spend, and the total revenue, the revenue that you receive from your business, if both the things are equal, then that particular point is called as break-even point. So one thing, as I told you, you have to try to reduce the cost by, you can go for some alternative methods. Instead of using laborers, you can go for machines. Instead of using machines, you can go for laborers. Instead of using fertilizers, which is of high cost, you can go for farmyard manure, organic manure, etc. In such a way, you have to reduce your cost so that the total cost will be equal to total revenue in a short period of time. It will come quickly. So that stage is called, that point is called break-even point. What happens here? You are making this cost even to the revenue. That means you are taking all the costs that you have incurred so far in your business, right? So that point is called break-even point, right? That point is denoted by point E. And another one is, as I told you, in a break-even point, you can see here, when a firm's total revenue is equal to its total economic cost, then it will break even. When a firm receives a price that will not cover at least its variable cost, it should shut down, right? I will tell you now. Now, when in a business, you can see here in this curve, when a business, the middle point, that is break-even point, where the total cost is equal to total revenue. Until this point, whatever money that you incur, that is a loss, because you are not taking the total money that you have invested, because slowly you will get revenue in your business. So revenue is here and cost is here. You are getting revenue on one side and you are investing money on another side. At some point, the revenue, it grows faster. You can see here. The revenue curve is steep, okay, and cost curve is somewhat horizontal, right? So it is growing very slowly, and revenue you are getting very fast because you are in a starting position of the business. So at some point, both becomes same. TC is equal to TR. At that point, it is called as break-even point, where there is no profit, no loss. There is neither profit nor loss. Until that point, it is loss. After that point, whatever that the owner is going to get, it will be a profit, because he has already taken the total money he has invested so far. That 30 lakhs for land, machine, buildings, that has been taken through the revenue that comes out of the business. So now he will be only investing variable cost alone, normally, not much of fixed cost. Depreciation and all will be coming at a fixed cost. It is of meager. Land tax also, it is very meager. Apart from that, they will incur only variable cost. Say, for example, one production cycle, they can incur 2 lakhs, they will get 6 lakhs, 4 lakhs profit. So whatever that they get after this break-even point, that will be a profit. And shutdown point, the second decision that you can make by using the cost concept is shutdown point. Right now, fixed cost, you keep it aside, right? Now you have taken the total fixed cost that you have incurred through your business. Now, in your business, you will spend some money to produce 1 unit of output. Say, for example, if you are producing, say for a chicken or whatever the product is, okay? Say, for example, you are producing a notebook. To produce a notebook, or to produce a chicken, or to produce a full cow, which is ready for sale, you would have spent some money. If the money, that money is called as variable cost, okay? Variable input to variable cost. If the money spent is 40,000, and when you sell this product outside, you have to get at least a price which is greater than 40,000, right? So that is average variable cost, that is cost incurred to produce 1 unit of output, that is cow. If you take rice also, if the total cost to produce rice 10 kg is, 100 kg is some 30,000 or whatever it is. If you divide it by total amount of output, you will get the average variable cost that is required to produce 1 unit of output. If it is 100 rupees, the price of the same output in the market should be greater than 100. That is P is greater than AVC. AVC is the average cost incurred to produce 1 unit of output. If it is 100 rupees, that is 100 rupees you have spent to produce it. So when you want to sell the same product outside the market, you have to get a price for the product which is greater than 100. That is P is greater than AVC. When you can enjoy this situation in the market, then it is worthy to run your business. When the P is lesser than AVC, you should stop producing anything. You should shut down your business. So that shutdown point is called, that point is called a shutdown point. Here you can see the total revenue that is coming out of the business is 2,400, and the money that the owner incurs to produce such output is called 2,400. Both are same, that is P is equal to AVC. So he's not getting anything extra, no extra benefit. So there is no point in running the business. There is no sense in opening the doors of the business. They should shut it down. Right now, you may have a doubt here. Sir, price is equal to AVC now at this point. The price is fluctuating phenomenon. No, it may fluctuate, it may increase or it may decrease in the future. So what happens if the price increases in the future? That time, the point P will be greater than AVC. He can produce further. Yes, that is why this shutdown point is not a permanent phenomenon. It is a temporary phenomenon, where whenever the price is equal to AVC or whenever the price falls much below AVC, you should stop producing anything in your business. Few businessmen, they still produce it because even though they get loss, they don't want to lose any regular customers in their business. So just to keep intact contact, just to keep intact with their customers, regular customers, even though they encounter loss in their business, they will still producing. They will never stop producing anything. But normally, as per the cost concept, when the price is equal to AVC or when the price is less than AVC, you have to stop producing the output in your business. And just to summarize, I think you are very clear about the break-even shutdown point. Break-even point is the point where P is equal to AC. That is whatever that you incur that you will take. And shutdown point is where P is equal to AVC. That is average cost to produce 1 unit of output. That will be equal to the price of that unit of output. At that kind of situation, you should stop producing it. Whenever the price is getting greater than the average variable cost for any product, it is worthy enough to produce any commodity in any business, right? So in this lecture, we were talking about all the different basic things about cost, different types of cost, total fixed cost, total variable cost, and total cost, and other average cost and marginal cost. And we have seen about opportunity cost. We have seen about sunk cost, explicit and implicit cost, recurring and non-recurring cost, incremental cost, and the importance of cost that can be understood by two concepts. That is, one is break-even point and another one is shutdown point. So with this, we will stop this lecture. I hope you enjoyed and understood this concept. We all will meet again in the future course of time with some other interesting topic to discuss. Until then, it is bye from Thulasiram. Thank you.